Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Jim Graf. He's the CEO of Graf Industrial Corporation, and we're going to look at trends in the SPAC market. Definitely becoming a hot topic of conversation recently in financial media. But before we get there, tell us what a SPAC is.
SPAC is a special purpose acquisition company. It's basically a blank check. We do an IPO with no business. For Graf Industrial, we raised $250 million. It sits in a trust account, and then we have a period of time, typically 18 months to 2 years, to find a business combination target. So you merge with that target, and through that merger, or reverse merger transaction, that target becomes listed. It's a means to take a private company public through our existing, essentially a public shell.
So if you are a retail investor and you want to get involved with a private company, if you were to buy shares in the SPAC, that gives you the exposure?
You can, as soon as we announce a transaction, so say we're going to complete a business combination with company A, our stock starts trading as a proxy for that transaction.
Got it.
And then once the merger happens, we're just a regular public company like any other public company.
All right, now tell us about some of the SPACs that you're serving as a director on.
So I'm the founder of Graf Industrial, founder and CEO. I've been involved in 4 other SPACs: Global Eagle, Silver Eagle, Double Eagle, where I was a member of the sponsor team and CFO, and I was a director of Platinum Eagle.
All right.
So this is my 5th SPAC.
So this is an old hat for you now. What your perspective on the SPAC market since your first SPAC that was Eagle in 2011? How does the market look then, and how does it look today?
It's completely different. Today, SPACs have become respectable. Almost every week, you'll see a multi-billion-dollar, high-quality company go public through a SPAC with high-quality sponsors, high-quality fundamental investors. It's happening all the time. You're seeing high-quality SPAC deals almost every week now. 9 years ago, there were still successful SPAC deals, but it was much more sporadic. You'd see a couple per year, but now it's become much more mainstream, much more well understood.
What do you look for in a target company?
You're looking for a couple of things. One, it has to be a public company on day one. So the management team needs to be ready to be a public company. For Graf Industrial, our primary focus is on companies that have a clear catalyst. There's some reason for them to go public through our SPAC. So it could be that there's a obvious acquisition target that they've identified. It could be a requirement for CapEx. It could be deleveraging. But the SPAC allows the owners to roll into the public company, use that public vehicle and our capital to achieve something, whether it's an acquisition or CapEx or paying down debt.
Why wouldn't they just go through the IPO process?
Well, typically, it used to be that we were always competing with IPOs. And we spent a lot of time with banks looking through failed IPOs and trying to find something we could take public through the SPAC. The fact of the matter is, if a company is a failed IPO, it's probably going to be a failed SPAC transaction as well, because ultimately you're going after the same fundamental investors. But one of the reasons, or some of the reasons why somebody may do a SPAC rather than an IPO is maybe the company's got a lot of growth. So we're looking at a number of situations where you've got a manufacturing business and a lot of new capacities coming online this year, and you've got committed offtake agreements, but you're not going to see that revenue until next year. But typically, SPACs can use forward projections. So if you need to price off of next year or 2021, a SPAC is a good way to go public. Another reason you might want to use a SPAC rather than a regular way IPO is that it's faster. We're already a public company. We've gone through that process. So you would file an S4 rather than S1. The whole approval process with the SEC can be much faster.
Does the quality of the sponsors make a difference?
It does. And I think that's one of the other things we've seen since 2011. You have a group of very high quality sponsors, big private equity firms, Fortune 500 CEOs, who have a following with the investors. So you're also seeing more fundamental investors play on the back end of SPACs, in part because they have long-standing relationships with these SPAC sponsors.
So that would probably help with the transformation that you've seen over the past decade in terms of quality of deals, the higher number of deals that are coming through the system.
Yeah, and part of it is that, let's say 9 years ago, even 5 years ago, we very rarely spoke to high-quality PE firms about going through their portfolios and taking those companies public through a SPAC. There were a very small number of banks that were working with SPACs, and that's changed a lot. Most of the discussions we have are with private equity firms. Most of the major investment banks have SPAC teams, and they're looking at SPACs as a kind of a specific product in those banks. For corporate finance, you'll have debt, or you could sell a company outright, or you could sell it to private equity, or do an IPO. And I think there's a lot more people in the market that understand the types of situations that are appropriate for SPACs, and that might be something like, say a private equity firm has owned a business for 5 years, and there's a big, so it's very late in their fund.
Right.
There may be a big acquisition target that could have $100 million in synergies, but is that private equity firm going to spend another $300 million or $500 million to make that acquisition? Probably not that late in their life. That core business may not be sexy enough to do a standalone IPO. You need the benefit of that follow-on transaction, or the potential for that follow-on transaction. So you probably couldn't take that business public by itself. You need that follow-on deal, but the PE firm can't fund that transaction itself. There could be private equity guys, other private equity investors lined up around the block trying to finance that if it's got so many synergies. But the fact is, private equity firm A may not want somebody else coming in the back of their deal. So that's a perfect situation for a SPAC, where private equity firm can roll their business into a SPAC, maintain control, and use our cash and public listing to make the follow-on acquisition, realize the benefits, and then they've got a liquid security they can exit in the future. All
right, to wrap up here, let's get your overview of capital formation for 2020. 2019 was a very interesting year. We saw companies that had a very long lifespan as a private company go public, and there's been a big disparity in terms of the multi-billion-dollar unicorns and some of the other companies that have come out. What are your thoughts for 2020? Do you think it'll look like last year did?
I don't know. Yeah. You're seeing massive SPAC capital formation. Over the last few years, you've got more and more issues. Every week we see new SPAC IPOs. There's a huge amount of money going into SPACs right now. So again, we think it's becoming it's a much more regular and recognized way for companies to access the capital markets.
All right, Jim, thanks so much for joining us at MarketSite.
Thank you.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.